Hello, everybody. It's Chris Hobart and, of course, Jacob Woodrum.
Hey.
I am the founder of Hobart Wealth and the guy that some of you know as the Wealthologist. Now, every month we try and get together to really cut through some of the noise. And man, I got to tell you what, these days there's a lot of noise, Jacob.
There is a lot.
Financial headlines, there's a lot. It can be a
Mhm.
bit of a mess. Sometimes we hear people shouting about interest rates, and next thing you know, they're predicting a recession. We've been in this boat a little
We
bit,
have.
talking with everybody, and
Yeah.
2 days later, they're celebrating record stock highs.
Right.
It has been whiplash, and if you're feeling that whiplash, you are not alone, and that's why this show exists. It's really meant to help make sense of everything, and also make decisions based upon facts and not fear.
It's a good point.
Yeah. So
Yeah.
now, if you are new to the program, welcome. Now, if you've been riding with us for a while, thanks for coming back. And here's how we do it. Every month we break things down using our framework called the three, the two, and the one. And that's where I have Jacob talk about three key economic events that you need to be knowing about right now. Number two, typically, Jacob's going to share two portfolio strategies that are going to work well in the current environment, or maybe something kind of unique or interesting that people need to know about. And then we're going to invite our special guest. I'll go ahead and tell you it's Andrew Greer, our senior wealth advisor here at Hobart Wealth. And he's going to share the one big financial issue or a tip that you need to be aware of right now. We are going to cover the big, beautiful bill in Andrew's segment today because that obviously passed. And it's something that we've got to kind of unpack and give you as much as we can. So as I mentioned, we've got two members of the team today. We've got Jacob, we've got Andrew. Now, before we do this, let's let a couple more people filter in. I always like to tell kind of what's going on. Now, we told you last time, what's going on with Jacob is he is a new dad for the second time.
Yeah.
So your life is pretty much that, right?
Pretty much that.
I know you've done a little bit of travel, and I think your family's been down.
Yeah, had some family visiting, which was fun. Did a little bit of traveling to the beach. We got one more beach trip coming up in 3 weeks. So
okay. So I don't want to brag, but once your kids get old enough, as my kids, you get to go on like these solo trips, or you get to maybe not have to worry about the little baby stuff as much anymore. And I will tell you, I had a really, really cool trip this past month. I was invited to go to the Green River in Utah. Now, as you may know, I like to fly fish. I'm not good at fly fishing. I can catch fish really well, but if you saw me cast, you would be like, Chris, I thought you've done this before. It does not look that way. So here's a couple of pictures from that
check it out. Wow.
And I got to tell you, I share these with you because I will tell you, it is probably one of the most beautiful places I've seen. We floated down the river with these, 500-foot cliffs of red sandstone all around us. Caught some beautiful fish. It was catch and release, just so everyone knows. I'm a catch and release type of guy. I enjoy the game, but I also like to let the fish go. I always give them a thank you and let them get back to their daily chores of being fish. So that's some of my excitement. Of course, I told you before, too, my daughter's headed off to college in a couple of weeks. We put that in the newsletter. yeah, it's crazy. Andrew, who's going to be joining us here shortly, he knew Sloan when she was, I think, 3 years old, I think is when he met her. So I think he's in that phase of thinking, wow, I'm starting to feel old as well. I've just another funny story. I went to go get my real ID today, finally, and my license, the lady looked at me. She's like, your license, sir, says you've got hazel eyes and brown hair. Should we keep that?
What'd you say? Yeah.
She was very kind, and I said we should probably change it. And then she looked at me. She said, "Shall we say gray or white?" And I was like, "Son of a gun! Guess we're going white." She was at least nice about it,
you know.
But anyhow. Let's get on with the show, shall we? As we mentioned, we're gonna invite Andrew back here in a couple minutes. Andrew's also going to be doing what's called the quickfire Q&A, and I love that segment because we've got 5 questions from our clients that Andrew's just got a couple of seconds to answer. Just give us a quick answer, and if you got more questions around that, you can reach out to somebody on the team.
Right.
But Jacob, are you ready?
Yeah, I'm ready.
You want to get started?
Yep.
Because we're going to start with that three, which are what are the 3 big economic factors going on right now, and what should we be considering when we're looking at that?
Yeah, now let's get into it. So the first topic that I want to talk about and what I've kind of labeled is focus on today's opportunities. Right now, the future feels more unpredictable than usual. To your point, Chris, earlier, what you were talking about, it's interesting because for a long time, investors could kind of count on steady trends or steadier trends, reliable trade, government debt that was a lot more manageable then than it is today, and more stable economic growth to kind of help plan for the long term. But today, those old patterns, they don't hold like they used to, which is quite interesting. So here's the good news. While the long-term picture is a little bit more cloudy, the short term actually is more clear, and that's interesting because I feel like typically we see the opposite. And so there's a bit of a shift there. Some parts of the economy, they just can't change overnight, and so that does give us more confidence in the here and now. It's why we believe it's smart to stay invested in U.S. stocks. There's exciting trends out there right now, like artificial intelligence, and U.S. companies, they're still making strong profits, even with the things like the tariffs, the policy changes in the mix, all the stuff that we've been dealing with. We're going to talk about this more in a little bit, but Europe, on the other hand, they still have more work to do, I think, before it can really compete. And so for now, the reality is it makes sense to focus on what we can see today and really stay flexible for whatever comes next.
And I like that because obviously that's practical. We can never see the whole future, but we can make those smart decisions. The thing that I think about with this is, we do have a lot of moving parts in the economy. You mentioned the tariffs, obviously, interest rates. Trump, whether you love him or whether you hate him, and I promise you, we know we've got folks on both sides of that one. What's very interesting is a lot of the things that he's doing that were predicted to have some significant economic impact, we're not necessarily seeing that, which is pretty interesting. The tariffs, and we talked about that for quite a while, that the tariffs wouldn't necessarily be this massive shock. It's where people actually begin to shift money. Now, again, we're early in this phase, so there's still time for those things to fall out. But my thing is, if you're out there waiting for a clear signal to invest, I would say maybe this is it. That it doesn't appear that the world's falling apart, and there's still a lot of good opportunity. There's not perfection out there, but there is clarity.
Yeah, I think that's a great way to put it. Let's move on to the next topic, which is, I've labeled this, when headlines don't always hit your wallet. Lately, we've had a lot of conflict in the Middle East, and it has grabbed a lot of the headlines. And it's natural for us to wonder, what does that mean for your investments? And the truth is, markets, they don't just react to the news itself. And this is so important. They react to how it actually affects the economy. And sometimes we don't always think about it in that way. But, if the conflict stays contained and doesn't disrupt oil or trade too much, history would show that markets can handle the noise and keep moving forward. And I think we've got a pretty impactful slide that we can look at on this as well, that specifically kind of shows to historically some events that really geopolitical events that have happened, and what the impact has been on the S&P 500 during those situations. So again, if we look here, we can see that between all of these events that we've had, what has been the 1 week return, the 1 month return, the size of the sell-off, the duration of the sell-off. And as I mentioned, if we don't see a disruption, and if this conflict stays contained, I think we're going to see that history can handle the noise, and we'll keep moving forward. You can see in the 70s, if the situation grows like we saw in the 70s, it could slow down the global economy, increase the risk of a recession. But that's not our base case. And right now, we do truly believe the risks are manageable as long as that conflict doesn't spread too widely or drag on for too long. So, as an investor, we know this, but it's important to be reminded of it. It's important for us to keep our eyes on the bigger economic picture, not just the headlines. Staying calm, staying focused really can help us avoid overreacting to that short-term noise.
Well, and I think that's important. We every time something goes on, it feels new.
Right.
And obviously it is new, but the reaction is, when we look back historically, a lot of times the market doesn't necessarily react. It kind of shrugs a lot of this stuff off.
Right.
While a lot of these events can be significant, again, when, like, I'm thinking, like, right now, what's going on today is I know there's talk of hitting Russia with some pretty significant, as well as ancillary countries with some pretty significant tariffs because of what's going on in Ukraine. And obviously that's some serious stuff, but
Yeah.
we're fairly removed from
Mhm.
what that looks like. And the economy and the world is so big now that even those types of things, we're not seeing necessarily these massive shocking impacts where the market's just like, oh my gosh, the market again is just kind of like, we'll see, but
Right.
it's not necessarily proving to be like a massive,
Right.
like just
Right. Well, and I think that we're going, our base case for the rest of this year from a market perspective is that, we could see some choppiness in this third quarter. I mean, we've had such a run, and to your point earlier, we had such a drop because of the tariff concern back in the early spring, and then we saw this amazing V recovery, and so it really wouldn't surprise us. I think we're probably going to get some choppiness and back and forth this year or this quarter, and then finish out the year strong. We'll see. We'll see if we're right, but that's really the base case. So, last point that I'll make on our three uh, area is why the U.S. still has the edge, and it's been interesting. We've had a lot of conversations around this internally, but also with our clients. Um, some people are starting to wonder if the U.S. is losing its lead in the global economy because we've seen European stocks and international stocks specifically do really well over this year compared to the domestic markets. But when you look closely, those European rallies don't usually last, and the U.S. still has some big advantages right now. And I think we've got one last chart on this to show, which is I think this one is really impactful as well. We're looking at really just the ratio of international European stocks versus U.S. stocks and the total returns really from '01 to 2025. And it's been so interesting because this year it's very evident that international is outperforming US, and you can see that on this little blip here on near 2025. It's easy to think that's a big deal, but when you pull the lens out and look at this chart, you can see that since '01 we've had a pretty steady decline, which just tells us that the U.S. is still the place to be from an investment standpoint. So even with the challenges like tariffs and I think cautious companies, U.S. businesses, they're still delivering strong earnings. Europe, in my opinion, they haven't made the deeper changes yet that you would need to outperform over the long term. It is making some progress, but the exciting areas like AI, they're much stronger in the U.S. than anywhere else, and there's a reason that what is it the top 4 or 5 trillion-dollar companies they're domiciled in the U.S. and that's because the U.S. is the place to be. So for all these reasons, I think we still believe the U.S. is the best place to invest. Strong economy, innovative companies, and the fact that I think investors they trust it more than other markets during uncertain times as well.
And the only thing that I mean, I'll kind of throw
Yeah.
a little thought your way, and again, don't you love it when all of a sudden Chris just says, "Hey, what about this?"
Right.
But I do know that China, when it comes to the AI world,
Yeah.
has significantly more capacity when it comes to their energy and power to actually support a growing AI. Now, the good news is, I believe I saw in the news this past week. Again, I've been traveling some, but I saw that Japan, I think, is making a massive investment in the United States into our, basically the world of power grid to ensure that we have more and more power, which is good that we have a partner like that doing that. It's actually a really interesting deal. I don't know if you saw the structure of it, but it's pretty favorable to the U.S.
Yeah.
I don't know though. I feel like China has quite a bit in capacity right now, and we've got to build towards that capacity. Just something that I kind of look at.
Yeah.
But at the end of the day, when the world does get shaky, where do investors run?
Right.
It's U.S. companies. They run to the dollar and the stability of our system. We've said it before. We're the cleanest shirt in the dirty laundry.
Right.
So no one's perfect, but at the end of the day, we tend to be the best.
Yep. Yeah, I think that's a great way to put it.
All right. Are you ready to move on to the number 2? And I messed up because I didn't do the little the fancy graphic that I have here.
Okay.
So now we get to move on to the 2, which are the 2 portfolios that are kind of compelling right now.
Yeah. So let's talk about that. The first one that I wanted to highlight We have talked about this before, but it's called our income growth plus model. And the way that I think about this strategy, it's dividends while you grow. And this strategy specifically, it balances about a 60% in stocks and 40% in bonds. But the intent in really what we're aiming to provide is a regular income stream through dividends. So it's going to include more stock exposure than certainly than a traditional just 100% bond focused plan or investment strategy, but it also has more potential to grow over time because of the allocation to equities that we have. So I think this is a smart option for investors who want solid income now, but we don't want to miss out on long-term growth potential.
And I think we hear that from a lot of our clients. I need my portfolio to create return or pay
Right.
me, but I still want it to grow. I think of somebody that's in their 50s, 60s, even 70s. You still have plenty of time, right? And you
Right.
want to
And
make
you
sure
need
that
that
you're,
growth.
yeah, you
Yeah.
need that growth. That's the one thing that I think has changed quite a bit. Is the old view from a retired standpoint was, I'm just going to live off the income.
Right.
Well, with inflation and everything that's been happening, you need that
Yeah.
growth to push that income
Yeah.
forward into the future.
Yeah, I think the combination of we're getting some stability with the income, that's going to happen
Mm-hmm.
regardless. But then knowing that we're going to help keep up with inflation too,
Yep.
that is key. Second strategy to talk a little bit about and highlight is our dynamic tax efficient select. Now, the way I think about this portfolio, it's smart growth, but it's tax savvy. And this strategy it's very unique, but it holds individual stocks, and we track an index like the S&P 500. It's built to grow with the market, but really with a lot more added flexibility. I think that's the key, because we can sell stocks, individual stocks that we own that have lost value to help us offset taxes, and that's just known as a term called tax loss harvesting. But it can also be customized based on specific preferences. So if we want to focus on only investing in socially responsible companies or value-based companies, we have the ability to customize that approach, which is really unique, and I think really works well
Mm-hmm.
for our clients. I think this strategy shines when markets are volatile, and we have had a volatile market this year. And so it does really make for a great tool, I think, one, to make sure we're staying on course, but also make sure we're keeping, taxes and the tax impact lower as well.
Yeah, and I gotta tell you, this is I love this because it's clean, it's
Mm-hmm.
efficient, it allows for a level of customization. You're buying and owning individual stocks,
Right.
and then we're also overlaying that tax efficiency.
Yeah.
I gotta tell you, in the world of kind of concierge wealth management, this is a great strategy because you can be very specific about what you own, why you
Right.
own it, avoid things that you may not want or you may not support. Again, you might have convictions that say, boy, I don't want vices in the portfolio. You might be on the other side and say, I want vices in the portfolio because they do well at different
Right.
times. But to avoid the tax consequences of some of this,
Yeah.
this is when we're really starting to talk about, let's be very smart with our money.
Mm-hmm.
Taxes matter, values matter, strategy matters,
Yeah.
and that's what this does. It kind of brings everything together, which I love
Yeah.
it.
Yeah.
So that's yeah, those are two great portfolios.
Yeah.
That second one, I again, the first portfolio, it's kind of that regular flavor.
It is.
Second portfolio, man, it is just, it's so meaningful, specifically as your net worth is higher and higher and
Yeah.
higher, to become that customized. Boy,
Yeah,
I got to tell
and
you, I love
that's the
that.
strategy that the tax loss harvesting strategy. Obviously, that's geared towards not an IRA but a non-qualified account, because the tax
Yeah,
piece is so important to
yeah.
folks, and it is really key.
But here's the interesting thing about that: you can still run that individual stock portfolio inside of an IRA.
Yes, you
It's just
can.
the tax piece where we
Right.
don't really have to worry about the tax consequences in there because you
Yeah.
buy sell and it doesn't matter.
Yeah.
So um, oh, great. Well, Jacob, I appreciate your insight
Yes, of
and your
course.
input and all of that. And I'm going to let you get on your way, and then we're going to be moving on to the number one segment of our segment, and that's the one big financial issue that we believe that you need to be paying attention to right now. And this month, we are going to be talking about taxes. And we're not talking about the ones you just filed. We're going to be talking about the new rules that just went into effect this year, um, with a big impact. So, as we talk about that, we're going to introduce, as I mentioned before, our senior wealth advisor at Hobart Wealth, Mr. Andrew Greer. Hey, Andrew.
Happy to be back. How's it
Yeah,
going?
good to be back as well.
Yeah.
Um, I'm looking at the camera right now, and I appreciate you shrinking the chair down a little bit.
Don't know what you're talking about.
For a guy that's a good 7 inches taller than me, this always feels good when I can look in a camera and see that I'm actually taller than you right now.
Who's counting?
All right, Andrew. Big beautiful bill.
Yeah.
It was talked about, bantered back and forth. It went through all the processes.
Lots of sensationalism.
Lots of sensationalism. Some worth it, some not worth it. But
Right.
now that it's here, now that it's official, we need to put some perspective out there, and we are going to be sending to our clients and folks on our newsletter an actual written up concept as to really what's most important. But I would love for you to give us a perspective on what's going on, what's important for our clients. What do we need to be looking at with this?
Yeah. I mean, what's interesting, when I was on, 2 months ago?
Yep.
On the Wealthologist back then, this was still a proposal.
Mm-hmm.
We did not know what the final version was going to look like. We didn't even know if it was going to be passed or not. But fast forward to today, we now have our new reality cut out for us for the next, 3.5 years,
Mm-hmm.
as far as tax legislation is concerned. Today, we're going to focus on really more of the personal tax aspect. Yes, there's a lot of tax legislation for small businesses, for entrepreneurs, things like that. But again, for today, we're going to focus on what we feel is most impactful to our client base on a personal level.
Mm-hmm.
So that's what we'll look at. But I would say, above and beyond anything else, the biggest thing that has been clarified for us is really it's going to be business as usual for the most part. Mm-hmm. Basically a continuation of the Tax Cuts and Jobs Act that was signed into law back in 2017, 2018, when Trump was in office the first time around.
Right.
And really what it does is it quells the concern that we've been carrying around for the last few years, which was, what's going to happen at the end of 2025 and starting in 2026 when the tax law sunsets. And that's a fancy term for taxes going up beginning in 2026. And again, what this ensures is, at least for the next 3.5 years, is that sunsetting provision is not
Mm-hmm.
going to occur. And again, we can debate, everything that's in the tax bill. There's thousands of pages. We won't do that. But again, I think it is a small victory on an individual tax basis.
Yeah, I think when you look at the individual basis, the reality is, if things sunset and went back to the way it was before, we're going to see most everybody, of any income bracket experiencing some sort of tax increase.
Yeah.
Again, our job today isn't to argue, is it good, is it bad, is it indifferent, but instead, what does it mean? What does the tax code look like? What has stayed the same? What can we expect? And then, importantly, what are the differences, or what are the important things that we can be doing right now?
Yeah. Well, you mentioned tax brackets, so let's
Mm-hmm.
let's start there. Again, for all intents and purposes, the tax brackets, as we kind of come to know them, they will stick around. So the 10% bracket, the 12% bracket, the 22% bracket, 24. Again, all of that's going to continue. Actually, what's happening is the 10 and the 12% bracket are widening a bit. Now, yes, the 22% bracket is condensing, but that's just simply a measure of the 10 and the 12% expanding. So
Mm-hmm.
all that means is we're forcing more income to be subjected to lower taxes, the 10 and the 12% bracket as a point.
Yay, lower taxes.
Exactly. And again, previously with the sunsetting, the 12 was going to be going up to the 15, the 22 was going up to the 24, the 24 was going up to the 28% bracket. Again, no longer a concern for the next 3.5 years. They do have a lot of permanent language in
Mm-hmm.
the current bill, and if it's okay, I'm going to refer to it as the bill as opposed to the big beautiful bill, just to save a couple of syllables.
I want you to say that each time, and you have to do it in Trump's voice. Is that fair?
Let me practice on that a little bit. I've actually lost my place. Where was I going with that?
We're talking about
Trump impersonation.
permanent.
Yeah,
that,
permanent.
that they have some things permanent language.
So as we all know, permanent, that's a little bit of a stretch. And anytime it's something coming from the government, I think we have to take that with face value. Again, when we hear permanent, we're talking about at least till the end of 2028. Where things go from there, again, anybody's guess. So that's one thing. The other one, we'll go through a few of them if that's all right. The next one is the standard deduction. Standard deduction was one of the concerns that we had. If things sunset, standard deduction was going to be cut in half. That's no longer the case. It's actually going to be increasing now. So for a single tax filer, standard deduction is $15,750. Married couple filing jointly, $31,500. For every individual in the household that's over, well, I shouldn't say individual in the household, for every tax filer that is over 65, there's an additional $1,600 deduction on top of that. So really for a married couple filing jointly, we're now looking at a roughly $36,000 standard deduction. So that's certainly a win in our book. Now, I'm going to come back to, if it's okay, the new senior deduction.
Okay. Yeah.
Because that's actually in addition to what we're talking about, but I'm going to come back to that,
okay,
if that's all right. The next one is the SALT deduction. So state and local income taxes. This was a big to-do. Frankly, I don't see a lot of North Carolina, South Carolina, Georgia, a majority of our client base in this area. I don't see too many people being impacted by this, but really, the Tax Cuts and Jobs Act capped state and local property taxes at $10,000 if we were itemizing. Okay, they've now taken that cap up to $40,000 per year. Now, again, why I say I don't see that impacting too many people in this area. This is really aimed at high income tax, high property tax states like our friends in New York, New Jersey, California. We could certainly see some dramatic improvements to deduction ability in those states.
And we could see some of that here in North Carolina, but we're still fairly protected. Unless you've got a super high value home. I mean, like in California, you can have a relatively small home that has massive taxes, and this is just a nice way of having a tax benefit to benefit you.
No doubt. Next one is the child tax credit. So that has been $2,000 per child, per qualifying child. That's now been increased to $2,200 per qualifying child. Now, I'm saying qualifying for a reason. What came along with that is that child has to have an assigned Social Security number. So that's actually been one of the changes. We're not going to debate right, wrong, what we believe there, but that's just the facts. That's what's that's looking at now, and that is something that is taking effect this year. What's also taking effect this year, I mentioned earlier, the additional senior deduction. So back when we first started hearing about the bill, there was a lot of discussion about making Social Security tax free. Here's the reality. I told a lot of people this when I was asked about it. That scenario already existed long before this new tax legislation. In retirement, if Social Security was your only income, you'd pay no taxes. So that reality was already out there. So I was not 100% certain exactly where they were going with that. But what we now know is, yes, Social Security can still be a taxable source of income. But what they've done to combat this, or what they've done to help seniors that are receiving Social Security with this, is this new senior deduction. So if you are 65 or older, you get an additional $6,000 deduction per person on top of either all of those standard deductions that we were talking about, or if you're still itemizing, it would be an additional deduction on top of that as well. With that said, there are income thresholds. So they start to phase out, or you start to disqualify yourself from that full amount of deduction when you start reaching, for a married couple filing jointly, $150,000 of income. Okay. It's completely phased out when you hit $250,000. So there's about a $100,000 income bracket there where you start to lose some of that additional deduction. Where we're seeing this in the cases that we've already run for clients is with Roth conversions. It's an additional wrinkle that we've just got to be aware of as we're having these planning conversations around whether or not Roth conversions make sense. this year or not. So just something to consider there. I won't get into new deductions for tips and overtime. Yes, that's in there. Again, if that's a concern, let's talk about it. We won't spend too much time on that. Also, you can deduct up to $10,000 on auto loan interest. I mean, that's a pretty substantial loan on an auto in order to maximize that. So again, we won't get into that too much.
Have you looked at the price of cars lately?
I
Holy
have.
smokes!
I think on a $200,000 car, you'd maximize that. So
well, maybe not. Well, I went out this weekend just as a quick aside, and I went to I had a buddy in town from New Zealand. In New Zealand, they only get these like little small kind of not great cars. So I took him to some dealerships in town that were just over the top dealerships, and I couldn't believe how much cars, the higher end cars that were just sitting on the lots cost. We went to the McLaren dealership, the Bentley dealership, and it was great. But I was like, oh, I love that. That's beautiful. Then I looked at the price and I thought, oh my Lord.
Yeah.
But hey, there you go.
There you go.
Just so we're aware,
if that's a concern.
Was not a buyer. And I sheepishly shrugged away.
What was that lime green thing I saw in the parking lot?
Yeah. Right.
No, the last one that I'll mention is an additional, again, we're kind of focusing on deductions, but that's where a lot of changes took place, was an additional charitable deduction. Even if you are using the standard deduction, so non-itemizers, for a single individual, single tax filer, you have the ability to deduct $1,000 in charitable gifts. Married couple filing jointly, you have the ability to deduct $2,000 of charitable giving. And again, that's above and beyond the standard deduction, which is unique. Have not been able to do that in previous years.
That's kind of a neat. It's neat. The one thing I will say is does add a little bit of complexity, right? I mean, what we're talking about are these kind of like little bolt-ons, and the tax code is already so complex, and now it's kind of like you have this additional area of saying, oh yeah, and this, and this, and this. Now, I mentioned that because that is also why it's so important as you're going through this journey right now. Asking questions of our team, Andrew and Corey and Nick, they are on top of this. Jacob has this from the investment side, but really making sure that you're dialed in is very important right now, because I got to tell you, it's easy to make mistakes right now, specifically with if you think everything's the same that it was a year ago. It's not. Opportunities have changed.
Well, the other thing is most of the time when we see tax legislation changing, it's for the upcoming year. This is a rare instance where it's happening mid-year.
Yeah, right. But it's mid-year. There are some good things inside of this tax change for our clients. Now, again, we can argue what it means long term for tax revenues and all of that.
Medicaid, all of that.
Yeah, we're not going to worry about that right now as much as saying how does it apply to folks, and will it benefit our clients? And I'll say that most of our clients are going to see some level of a benefit based upon some of these things. And that's the thing I'll tell you. If you're retired, or maybe you're close to retired, or if you are earning a high income, this year's changes, it deserves a review. No doubt. Yeah. The thing not to do is don't just take last year's plan and copy and paste it going forward, because it's just it will not work that way at all.
Right.
All right. Are you ready?
Is this quick fire?
This is quick fire. That's right. I need to have some music here.
I was thinking the same thing.
Because you just said that, and everyone at home watching was expecting something exciting, and then it's like a graphic and us talking. All right, Andrew, we've got quick fire Q&A. What we're going to do here is I'm going to throw these questions at you. You do not have long to answer. We're talking one sentence, two sentences, and we're moving on. Okay. Are you ready?
I'm ready.
Okay, first question. With the new tax law, should I do a Roth conversion this year?
Yes. And I would say, generally speaking, every year this needs to be a consideration. But if you're in a lower tax bracket today than you expect to be in future years, this could be a prime window of consideration. Absolutely.
All right. I am 59 years old. Should I increase my stock exposure right now?
If not now, when? No, I'm kidding. Depends on your risk tolerance, obviously, and time horizon. So if you've got at least 5 to 10 years, let's say, yes, that could make sense. But please make sure you are taking a balanced approach.
All right. Does the senior deduction affect my Medicare premiums?
Good question. Very appropriate for what's going on now. So, not directly, but in general, lower taxable income can affect your IRMA or Medicare brackets. So, yes, it does matter.
Okay, perfect. Now we talked about that SALT increase as well, Andrew. The SALT cap increases, but what happens after 2029?
So, what we know for now is that that will revert back to the original $10,000 cap if nothing changes before then.
Okay, so in other words, pay off your house.
Sure.
Or well, I guess that doesn't matter with the SALT stuff, so never mind. All right, and then finally, can I deduct charity if I don't itemize? And we touched on this a little bit, but a good one to recap.
Yeah, well, and what I would add to this, so the answer is yes. That's one of the bigger changes that we've seen this year. So up to $1,000 single, $2,000 joint, even if you take the standard deduction. But this is one of the wrinkles that takes effect starting in 2026.
Not 2025.
No, you know what? I take that back. I think I might have misspoken. As I was preparing for that section, I might have misspoken. No, so that is taking effect in 2025.
Okay, so it is 2025. Okay,
yes,
perfect. All right, well, good deal. That's that makes sense. Well, thank you. I appreciate your insight and your input on those quick questions. If you're at home right now and you've got questions, whether they come up right now or they come up a little bit later, just drop us a line. You can send them to us directly, or you can send it to heyhobart@hobartwealth.com, and we will be more than happy to feature your question on next month's Wealthologist Live. Now, Andrew, every time that we wrap up the Wealthologist, I kind of like to have that perspective, right? Kind of step back a little bit, because a lot of times it's easy to get caught up in the data that Jacob's talking about, or the headlines, tax code changes. And sometimes when we do that, we lose focus on what we're really talking about today, which is, clarity and really clarity in the chaos itself. Because when markets fluctuate and when legislation changes, when life doesn't go according to plan, which we've all seen that in our lives, it's that clarity that helps you stay confident and know that your plan's working. And the thing is, clarity doesn't come from guessing it comes from planning. So if anything that you heard today made you think I should probably talk to somebody, do it. And if you know someone in your life who could use some financial clarity right now, we would be honored if you referred them to us. That's how our community grows. We love to help people here at Hobart Wealth. My team is a phenomenal team, as you saw today and as you've experienced. And we'd love to spread that confidence to you and your family. All right. Well, as always, I am Chris Hobart. I am the Wealthologist. And again, I want to thank you for joining us. Until next time, I encourage you, be well, be intentional with what you're doing, and we'll see you next month on Wealthologist Live.